If silver were one global frictionless market, that spread would close fast. Arbitrage would do its job, metals and would move, the gap would compress, but this one hasn't behaved like a normal clean arbitrage. That does not automatically mean a shortage. It does not automatically mean the COMEX is finished, and it does not automatically mean China is about to reset the world. Now, China is not transparent market. Data can be delayed. Inventories can move off exchange. Policies can matter more than economics. So our job is to separate a policy premium from the real physical tightness. Joining me is David Morgan, publisher of the Morgan Report. David is the author of the Silver Manifesto and has tracked these markets for decades, from the Hunt brothers to the ETF-led markets that you're seeing now. David, good to have you back. Thanks for joining us.
Well, thank you, Jeremy. It's good to be here.
Well, let's get to, I don't want it to be fact and fiction because, again, some of this data is a little bit reclusive, but it comes at us very quickly, as you know. And as of today, we talk about the Shanghai silver benchmark. It's fixing at around $82.60 an ounce, roughly $10 above the Western spot price. I guess first, explain why that adjustment isn't happening automatically. Is it VAT? Is it capital controls? Or does it suggest localized strain?
Well, it's really all three. First of all, it's localized strain. Obviously, if you're willing to pay more than the benchmark price, in New York, it's going to bring flow over to China. But what are the problems? It's, loading it up, inventorying it, shipping it across. And I've gotten different numbers on how much per ounce that costs, so I won't give you a bad number because I don't know what it is. But it's worth the $10 spread. However, it's really not happening that much. It is moving into China. There's little doubt about that. But the spread hasn't closed, as you said, Jeremy. So something's up. I think over time it will narrow, and I think we'll probably get into a situation where the price in London, the price in New York, and the price in Shanghai is pretty much the same.
Yeah. And let's elevate this. If this were a broader monetary shift in pricing power from west to east, wouldn't we expect the same structure premium in gold? Why is silver showing a level of tension that, gold is not?
I think the main thing is, how these three markets are set up. You've got the COMEX, which really sets the price by a derivatives market. You've got the LBMA, which is an exchange. It's an association, and it's kind of a good boys club that kind of move metal around as necessary. And it does supply the physical side. And then you've got Shanghai, which is basically set up for industrial users of silver. So that's sort of where the rubber meets the road. It is a futures market, but not to the extent that London and New York are, which means a lot of that silver that's in inventory or on the exchange is going to be taken by somebody for purposes of either investment or industry.
Yeah. And at what point does the diagnosis change? When does regional friction officially become a structural fracture? Is it duration? Is it just the size of spread?
I'm going to jump a little bit ahead on that, Jeremy. So what I'd like to do is just kind of set a little bit of a foundation. So what we have seen for decades in silver is that the COMEX sets the price, and that does set the physical price. And as long as there's enough physical to meet demand at that price, then everything's good. And once in a while, you would see it slip away. And it'd be usually for a matter of 3 days. You'd see a big backwardation. It lasts for a couple of days, and then all of a sudden there'd be enough silver to fill that gap. Everyone's satisfied. The people that had to have silver that day got it, and things go back to normal. This time it's different. What's different? Well, what's different this time is that China is using this big demand for physical metal is in the arena of the COMEX, meaning it's commercial 1,000-ounce bars. So even though the retail market can have an effect, it's a flea on a dog relative to the tail of the dog. So once the industrial needs were not met, you saw that the physical market took over the silver price. And that has happened, as I said, very sporadically in the past. This time, it was the real deal. And we saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. We haven't seen those kind of years in a long time. Secondly, we saw what happened in January as the price went up 70% in 1 month. Now, I am not here to be an apologist for the bankers. Anyone that's listened to me for more than 5 minutes knows my thoughts about that. However, it is a derivatives market, even in China. The market did get ahead of itself, and it was overextended, and the paper price or the paper paradigm took over. So temporarily, even though the physical 1,000-ounce bar market had basically taken control for weeks, perhaps months, and everybody's kind of cheering that understood what was really happening, it didn't negate what was going on in the futures exchanges around the world. And again, they got ahead of themselves. There's lots of talk about what happened, about a huge Chinese short. I think part of that's true. I haven't been able to verify it, but a good friend that's a hedge funds manager verified it to me. So that brought things back into reality. So that is now where we are. So now we're in a struggle between who's going to win from this point.
The state bought its first physical gold. And so when you look at the state of Wyoming, though, they're sitting on, this is out of a $33 billion trust that they invest in all kinds of things. So they can pick and choose what they want to invest in. And now, I'd say the plumbing is in for the physical metal. And something viewers should pay attention to is the new Basel III changes in banking regs. So if a bank is owning paper product of gold, it's considered 75% risk-free on their balance sheets. If they own the physical item, it's 100% risk-free on their balance sheets. So I think what we're watching here is precious metals are being viewed as a treasury asset at a minimum. People are holding it. You're seeing Poland going up to 37% here in 2026. 37% of their balance sheet will be gold. And I believe a third of whatever they're buying, I think, is going into New York. And so people are diversifying away from the US dollar. And then they go, well, what other currency do you really trust out there? The EU has a lot of problems. Obviously, I think, you could look at China and say, I don't feel too comfortable with it, which is also why they're using gold as settlement layers now as well. So really the world is moving towards a trustless commodity that people want to own and they want to hold. Yeah. And so I think the state of Wyoming does show, I know I'm getting contacted by a lot of, big news media outlets going, what is going on with the states? And I said, pay attention. There's going to be more bills being run. The United States has a lot of states that have zero gold. Almost very few of them have any. Some have some. We saw Utah last year bought gold as well. And so when you look at central banks, the guys that had zero, they're going to 1 to 3% allocation. The 1 to 3% allocations are going to 5 to 6 and beyond. And so I could see. So you take a state like Wyoming, who's got, I think they have about 50 billion in liquid assets. But I think in that middle trust alone, 33 billion. So if they start doing these applications similar to the central banks, suddenly the U.S. states become a huge player in the gold market. And then it'll be interesting. Do they start looking at silver? We've seen, Russia look at silver. Poland is now talking about looking at silver as, again, another treasury asset. It's definitely not the same monetary strength of gold in the same sense, but is it something to invest in? Obviously, we had J.D. Vance just a few days ago announce critical minerals, $12 billion that they're owning, and silver's on that list. So there's no doubt that really entities at all level are clamoring for these precious metals products.
Yeah, I mean, it's pretty wild news, because if Wyoming is kind of the sovereign buyer model and Texas is the sovereign distributor model, I mean, does this signal a broader evolution in how states approach physical metals?
That's a good take. I would say, I was in the state capitol, I was talking. I always look at Wyoming and Texas are like brothers. Now, Texas is the big brother, right, by far. But they're very similar. They both have a heritage of energy. And very, if you look at the politics historically, the governors are typically very aligned. And so it is very much Texas is, I think, is the number one energy exporter. Wyoming's number two. So if we start looking at strategic resources, all across, really the spectrum, these are very critical states for the U.S. economy, the GDP, and especially look at your country, Canada, Alberta, kind of carries that same weight, and it's the vast majority of the GDP of Canada. So those strategic, I think, if we want to look back, if you want to take a movie like Hunger Games, we start looking at districts, who provides the most, let's say, assets in for the state, and who's actually sucking the resources out. It's kind of interesting to watch this take place. So we're seeing some of the stronger states, they're allocating. The weaker states who have unfunded liabilities, their businesses are leaving. So, I think, pay attention to the sound money rankings of states. Wyoming's number one. I forget where Texas is on the list, but they got an awful lot of people to deal with. But there's definitely a trend, I think, that these states are some of them are starting to lead from the front. And if you've ever spent any time in watching any of these bills being run in any state, the big problem that all states have right now is finance. Things are broken. Their budgets are broken. The expenses to do something new and road repairs, everything's broken. And the reality is who should we be blaming for this?
The writing is on the wall. While the paper markets in New York try to manage the price, the physical markets in Texas, Wyoming, and Shanghai are draining the supply. We are moving from a world of gold as a trade to gold as a treasury necessity. The question is no longer if the system will reset, but how much physical metal you hold when it does. Let us know in the comments. Do you trust the COMEX price, or are you following the states into physical delivery? Stay stalking.